You're listening to Let's Talk Macro.
Hi, welcome to Let's Talk Macro, the new podcast on macroeconomics by IDFC Mutual Fund. I'm Sreejith Balasubramanian, Economist in the Fixed Income Fund Management team, and it's my pleasure to present the first edition of this podcast. We look forward to bringing you interesting, important, and topical macroeconomic topics, both global and domestic here. Now, this would include relevant economic data, concepts, events, the inferences and implications we derive from them, and a lot, but we hope to keep it really simple for our listeners. With that note, let's go right to the topic for the day, which is US inflation. What we'll do today is look at how the underlying drivers of US inflation have changed, what various other measures of inflation tell us, recent developments in inflation expectations, and the rest ahead. Now, just to set the context, we know US inflation has been, for a while, much higher than the Fed's target of 2%. Recent CPI inflation prints tell us, although the headline number is off its peak in June, at least in year-on-year terms, it continues to stay very elevated. On the other hand, core inflation, which is essentially nothing but the headline number excluding the volatile components of food and energy, and core inflation is usually a better barometer of underlying consumer inflation. This has actually moved up, not just in year-on-year terms, but sequentially as well. So first, the underlying drivers and how they've changed. Back in 2021, used vehicle prices had spiked significantly when new vehicle manufacturing was hit by severe supply shortages of semiconductor chips. I hope you all remember that. Economic reopening after strict government restrictions imposed during the initial phase of the pandemic, once they were relaxed, and the increase in vaccination rates, and thus less fear among people, also contributed to the rise in inflation. Now, a very crucial aspect during that period, and to a certain extent even in play now, was a strong consumer demand, particularly for durable goods, driven by multiple rounds of general fiscal stimulus in the US in the form of unemployment insurance and direct cash payments. Now, headline and core CPI both mostly moved in the same direction then, but this narrative has changed now totally in 2022. Now in 2022, two things have happened. One, energy prices spiked after the onset of the Russia-Ukraine war, and consumer spending actually rotated from goods, that is mainly durables, to services. Now, this essentially meant headline and core inflation were actually no longer moving together as they did in 2021. Now, more importantly, housing, of which a major component is actually rent paid, has been picking up. And this is now a stronger driver of inflation than prices of vehicles. Now, rental inflation is typically sticky and lags house price changes. So this could potentially actually stay high for some time. Now, although the growth in house prices have dropped recently after the Fed has started hiking rates, the very high mortgage rates there now in buying a house and the employment and income uncertainty that people face, which can actually deter house purchases, means actually rents could continue to face upward pressure for some time. Now, combine this with a high weightage of rents in the US CPI basket, which is almost like a 1/3, it's almost 32% there. It means rents could actually be a major driver of inflation readings ahead. This is one part. Now, the second is a very useful way to understand how broad-based and sticky inflation is actually is in the US, and that is to look at the various alternative measures of inflation that regional Federal Reserve banks in the US provide. For example, I have two measures for you. One is, if you look at the Cleveland Fed, they calculate a measure called the trim mean CPI. And if you look at the Atlanta Fed, they calculate something called a sticky price CPI, and this is done monthly. Now, these measures gauge the underlying inflation by either excluding a fixed percentage of components every month, in the highest and lowest categories of price movement, or they actually include only those components, prices of which typically move relatively slowly. So they're essentially basic alternative measures of core inflation, trying to get a feel of what the underlying and less volatile part of inflation is. These measures actually continue to move up since late last year, that is late 2021. And what this means is inflation pressures remain broad-based and sticky, despite energy prices falling and the consumption rotation that I just mentioned from goods to services. That is the second part. Third, in India, we have the wholesale price index and the consumer price index, which is the WP and the CPI. And this is actually to measure price changes at different points in the system. One at the wholesale level and the other is at the retail level. Similarly, in the US, we have something called the producer price index, which is the PPI, which actually measures prices at the producer level. And we also have something called the import price index, which is the IPI, which again, very simplistically put, measures prices of imported items. Now, these two measures, that is the PPI and the IPI, correlate quite well with the consumer price inflation, but obviously with a time lag. Now, both these measures, particularly the import price index, have actually moderated in year-on-year terms. This actually offers some scope for slower growth in goods inflation in the US. In fact, if you look at China's producer price index inflation, which is again very well correlated with the US import price index, obviously because US imports a lot of goods from China. And this is also correlated with the CPI, but again with a lag. So China's PPI is eased quite substantially. So all of this actually augur well for consumer goods inflation in the US, which could actually come down from what you actually see in these measures. The fourth thing is actually a major fundamental driver of inflation and something the Fed looks at very closely: inflation expectations. Measured through surveys and market-based measures, they influence the future inflation trajectory. Long-term inflation expectations remaining anchored is very crucial for any central bank's credibility and thus for monetary policy to be effective. Inflation expectations have more recently moderated, whether you look at market-based measures, consumer surveys, or business surveys. Now, all this actually reflect several factors, but definitely the Fed's forward guidance that it would actually raise interest rates higher than previously expected and maintain restrictive policy for some time, even at the cost of a sustained period of below trend growth and softer labor market. Nevertheless, this moderation is actually good. Now, a word on the risk to inflation. So downside risk for inflation could stem from various factors. One, slower growth. It can be both domestic and elsewhere, as Europe and China are also very likely to slow. Two, decongestion of supply chains. In fact, shipping costs have actually come off recently. Three, effect of lower wealth on consumption expenditure. So tighter financial conditions as the Fed raises rates will impact house prices and equity values. And even falling personal savings will have its impact on consumption. And four, a deteriorating outlook for employment and wage growth, which are actually already reflecting in consumer confidence surveys. On the other hand, if you look at the upside risk to inflation, this could actually include higher and sticky rents, which we mentioned earlier, slower than expected correction in wage growth, which actually remains high and is expected to slow, geopolitical risks, particularly for energy prices, and any manifestation of global financial market pressures and central banks' response to this, like the Fed, for instance. So to summarize, one, the underlying drivers of US inflation have changed in 2022, with services, particularly rents, moving up versus goods in 2021. Two, various other measures of core inflation provided by the regional Federal Reserve banks, for example, continue to move up, and this tells us inflation pressures remain broad-based and sticky despite energy prices falling and the rotational consumption from goods to services. Three, growth in the US producer price and import price indices and even China's producer price index have all eased, and this is good news for goods inflation in the US. Four, various measures of inflation expectations, like we just looked at survey measures and market-based measures, have all moderated, and long-term expectations remain pretty much anchored. And finally, five, we also saw the upside and downside risks. Now, all said, the major point here is that we need to be very analytical when we interpret each data print that comes out for US inflation. That's it from me for now. We hope you find this podcast useful. We'll be back with another episode of Let's Talk Macro. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.